Every person on the internet is trying to convince you that you can get rich with the stock market and investing. Have you seen articles talking about stocks that'll double in a year? What about a DeFi crypto that'll basically guarantee 30 to 50% returns in a year? We've seen ridiculous examples of big stocks like Tesla going up 760% in 5 years. But just how realistic are these 1000% returns that we see posted online, and what can we learn from them? In this video, I'm going to present statistics about penny stocks, Ponzi schemes, and just what are realistic expectations when it comes to returns in the stock market. The goal by the end of this video is that you won't be tempted by these clickbait titles or articles telling that you can make 1000% returns on stocks by doing absolutely nothing. Penny stocks are a wild place, and I hope that you never make it to that side of the internet. And while penny stocks are pretty much worthless, there are the examples of stocks going up 1000% in just a couple days.
6 cents a share? Come on, who buys this crap? Honestly, mostly schmucks.
And I'm looking at you and I know that you're not a schmuck, so how do you fall for a trap like this? Because it's very obvious from the outside that these stocks have no value to them. It's because you see the success cases and people get tempted by the incredible returns. They're starting to count their money already before they've even made their trade. And historically, they're not going to make money from it, but they see the potential. It's kind of like getting a scratch-off ticket. You know that you're likely not going to make money, but you see it as a potential way to get rich, and it's tempting you and just kind of pulling you in. You can do a quick Google search about stocks or penny stocks that'll double in the next year, and I kind of wanted to see how they've done because they make these gigantic claims about doubling in a year. So let's see how they did. I just searched in 7 penny stocks are going to explode in 2022. This was a video that was posted, or an article that was posted at the end of 2021, and I wanted to see how they did because yes, you can make this before it happens, and I wanted to look back to see how they actually did. As you'd expect, pretty much some of them are awful, going down around 90%, but some of them did do really well. As we pan up on the graph, you can see one that was up 135% and the other one was up 228%. So there were some winners from this article. So that's not bad, right? Well, let's zoom out a little bit because on this channel, we're promoting long-term investing. So let's see how these stocks have done over the past 5 years. And as you'd expect, the success rate goes down significantly. When we look at the 5-year chart, only 2 out of the 7 are positive and most of them are down 40%. And if you split your money evenly between all of these stocks, what type of returns are you going to be looking at? For the 5-year chart, you're going to be down 20%. When you look at the S&P 500, which has been the historical best place to invest reliably, would be up 47% during that time. And you would get those returns with significantly less stress. And you know what else is less stress? Making sure that you know when I'm going to post next by hitting that subscribe button and making sure that you're turning on notifications. So penny stocks rope you in with these incredible promises of high return. This article talks about, a lot of times they can go up 5, 6, 7-fold, but we would take a 50 to 100% return, making it sound like that's the norm. Let's look at the statistics to see how they've done historically, because before you start investing in any type of stock, you kind of want to know what historically they've done. So when we talk about the historical returns of the stock market, over the past 100 years, the S&P 500 on average has returned 10%. When you look at penny stocks, how have they done? Are they up 15%? Are they even? Are they down? Yeah, as you'd expect, they're down pretty bad. They're down 24% annually, and on average, 92% of them go bankrupt. So historically, you are not buying the winners, you're likely gonna buy a loser, and your money and your value is gonna go down the drain with it. And so you look at penny stocks, and a lot of people aren't gonna fall for this, but a lot of people won't see the same similarities with speculative stocks. Speculative stocks are ones that are traded on the major stock exchanges, and maybe you've heard of them, maybe you haven't, but they don't make any money, and they're speculative because you're hoping that they're going to turn a profit in the future, and you're hoping that people are going to push up the price significantly. And someone that I pick on a lot on this channel is Jeremy from Financial Education, because he keeps pushing these ridiculous stocks like Palantir, and the one we're going to talk about today is ttcf, or Tattooed Chef. This video that he posted on October 8th, 2011 says why ttcf stock will 10x, and then in parentheses, in case you didn't know how much that was, that's plus 1000%. And let's see how the stock has done just since he's posted that video, because he's made so many videos. You can just scroll on his page, seeing all the ttcf videos that he's posted in the past. Since that video came out, the stock price is down 92%. So instead of going up 1000%, it is down 92%. Let's move from the penny stocks and the speculative stocks to the videos that are talking about how to make 1% a week trading in the stock market. Because, 1000%, I think we can all agree that's pretty unrealistic, but 1%, that's just a small number. 1%, who cares? That's not that much. So let's talk about 1% returns, because let's put this guy on screen right now. You may know him, you may not. He's pretty well known. Let's actually update that video to see what he looks like now.
Where Bernie Madoff has just been sentenced for the biggest investment fraud in Wall Street history.
This is Bernie Madoff, the founder and the mastermind behind the largest Ponzi scheme that we've had at this point. I feel like anytime you talk about the largest of all time or the best, you have to say up until this point, because most likely it's going to happen bigger and worse in the future. For those of you who don't know, a Ponzi scheme is the idea that you bring in investors early on who put their money into the Ponzi scheme, and then the next round of investors are the ones that are paying out the money to the earlier investors. So the more people you bring in, the better returns you're going to see, and it makes it seem like they bring in these historically stable returns. And when you look at it, how well did Bernie Madoff do? He had this way that he was basically printing money and really didn't have to trade stocks at all. It was just bringing in the next person to pay for the previous members of the Ponzi scheme. What percent returns was he promising? He was only promising 11% returns, but the kicker, the big thing with him is that they never had a losing year. So he always made these pretty much reliable 11% returns. If it was a 100% return, you would look at it and go, yeah, that's a scam. But 11% seems pretty realistic. So what can we learn from this? The big thing is that they claim to never have a losing year. And that is something that we really need to remember. We hear 10% returns a year, and you kind of assume that's going to be the usual. You expect your portfolio to go up 10%, and when it doesn't, you feel pretty bad about it because you've heard about these historical averages for the past 100 years, and when it doesn't meet your expectations, you must be doing something wrong is kind of how your brain immediately goes to. So what's the biggest thing that we can take away from these Ponzi schemes is that 1% a week is not realistic. You're gonna have ups and downs, and 1% without having losing weeks at all is gonna be so unrealistic that even though it's not the 1,000% returns that we were talking about with ttcf or some of these penny stocks, they're pretty unrealistic in their own way, and I feel like it's important to talk about. Even the best traders in the world, the guys that are managing the hedge funds that you've heard of, they also have bad years. Historically, when you look at 5-year spans of the overall market, hedge funds on average have underperformed the overall market, but the thing that they do well is that they have better bad years. And so even though they don't have the historical great returns as the market's doing well, they kind of limit some of their downside, so they do have some benefit there, but they are not perfect. Not everyone's going to be making money consistently, and I think that's a huge takeaway that you should have from this video. So what's a realistic return? What can we expect? Because everyone's trying to maximize their returns. You can see the difference in having 5% returns for the next 40 years compared to 6%. It's just a 1% difference per year, but how much does that add up over time? In the next 40 years, that 1% difference is going to be a 28% difference in your return. So all of these little percentage points that in 1 year may not seem like a lot really add up over time. And that's why in the past video I was talking about investing mistakes that you should avoid at all costs, because these little losses are going to be the ones that are going to make it so your returns really slow down over time. So we're trying to maximize returns, and I feel like that's how a lot of people get into this trap of trying to find the best returns out there. So what are realistic expectations for returns? I've talked about the historic returns of the S&P 500 being around 10% annually, but we were talking about Bernie Madoff making 11%, so why is that unrealistic versus the 10%? It's only a 1% difference. It's going to be 28% over the next 40 years. So what's the difference there? The big difference, one of them, is that Bernie Madoff was only doing it for 20 years, whereas the historical average of the S&P 500 is 100 years. And the more data you have, the more comfortable you can feel about the historical returns and the trend that we've been seeing. It's really important to note that historic returns do not promise future returns, so that's why we have to use a range of expectations going forward, and we can't just assume that what we've seen in the past is going to be what we're going to see in the future. The big difference that we need to acknowledge is that there are going to be red years. We're not Bernie Madoff. We don't have this infinite money source where we can make it seem like we don't ever lose money. We are going to have down years, and when you look at this graph of annual returns of the S&P 500 for the past 100 years, you can see that there are some really big red years, especially in the 30s and the 70s, as we had some major problems that we had to deal with that were making these markets so volatile. But we need to remember that there are going to be down years and even down couple years. You have bear markets historically, but we have longer bull markets on average, which is why historically the S&P 500 on an annualized basis returns 10% a year. So we need to remember that not every year is going to be a plus 10% year. We're going to have a plus 30% year, and then the following year we could have a down 25% year, but over the long term we have seen that average sit around 10%. So if your portfolio is down for the past year or so, that's okay. The market's down. You don't have to have this incredibly reliable plus 10% a year because it's not realistic. We're not Bernie Madoff. We don't have this infinite money. We are just going along with the overall market, and if things are going down, we're probably going to go down with it. And I think that's okay, and we need to acknowledge that. So let's talk about what I look at for realistic expectations for my returns. We've seen 10% a year. We don't have any guarantee that's what it's going to be in the future, so I like to sit around 9% when I'm kind of calculating what my future potential is going to look like, but that's just kind of the midpoint. I think whenever you make an important financial decision, you need to have a best and worst case scenario included with that average expectation. So we have the 9%, which is what I hope what we're going to see, but I also do my calculations with 6% and 12%. These are the best and worst case scenario, just to kind of see what my potential is. This is the idea of stress testing a retirement account. Because yes, you have the potential and the data that we've had in the past to kind of extrapolate and hope to be able to judge if you're going to be able to retire safely, but you need to have the assumptions of there's going to be a huge bear market, or we can also have the assumption that there's going to be incredibly positive market conditions and your stock price is going to go up 20% in a year. You need to have both sides of that, and you need to stick somewhere in the middle to have realistic expectations. You could have that 12% as being what do you think is going to happen, but then if that doesn't happen, what is that going to do to your portfolio? Are you going to be really disappointed by it? Is it going to push back your retirement timeline 5, 6, 7 years? You need to have realistic expectations for when it comes to returns and have a worst case and a best case scenario. So what are the main takeaways that I want you to have from this video? The first one is that clickbait can be dangerous. You can go on YouTube and find any type of ridiculous claims out there. Stocks that are going to double in a week. Stocks that are going to 1,000% jump in the next year. Stuff that's going to be the next Tesla that's going to the moon. You have these cryptocurrencies that the phrase has become they're going to bring you to the moon, this idea that they're going to bring you there safely, when historically they are going to crash and burn, pretty much like any of these other speculative stocks and penny stocks. So whenever you see clickbait, I hope that you're less likely to fall for it because you've seen the historical numbers about why we should not believe them. This doesn't mean that there won't be 1,000% winners, but historically, if you're throwing a lot of money and you're just picking stocks with a dartboard, historically, on average, you are going to lose, and we're trying to avoid that at all costs. Number 2, the stock market has down years. Bernie Madoff promised 11% returns, but he had no down years, and that's not realistic for normal investors. Normal years can be up and down. Right now, we're in the middle of a bear market, so a lot of portfolios are down, and that is okay. The stock market goes down, but historically, on average, it goes up 10%. So we can have a plus 30% year, followed by a down 20% year, but on average, if we're long-term investors, which is the whole point of this channel, is that we are going to build wealth over time, and it's not going to build wealth within a 1-year chunk. Stock price could go up or down, but over the long term, we are betting that it's going to go up in value. And then finally, realistic expectations for the stock market are so important. You need to have your best case and your worst case scenario as well as your middle point. We've seen the 10% return to the stock market, but we cannot guarantee that's what it's going to be for the next 40 years when I go to retire. So you need to have a low point, which is what I use as 6%, and then you need to have the best case scenario as 12%. And you use those in your calculations to kind of see what I'm doing. If things are going well, if we have a fantastic next decade, where is it going to set me up? But what if we also have a really long recession and I'm not having the returns that I expected? You need to have that range and have realistic expectations and not assume that every year your stock price is going to go up 10% because that's not realistic. This goes along with the idea of you need to know what's going to happen if you buy a stock and it goes down 30%, because that's possible. But you also need to know what you're going to do with the stock if it goes up 50% in a year, because this is the best case and worst case scenario, and you need to be ready for all of it. And that's kind of the idea of this channel, is to be ready for anything that happens so that you can push your financial progress forward and try to avoid some of the baby steps backwards that a lot of these mistakes or unrealistic expectations could put you with for the future. So my name is Andy. If you made it this far in this video, be sure to hit that like and subscribe button, as we're trying to get to 10,000 subscribers eventually. And there'll be additional videos up on the screen right now if you want to see more videos from me. Thanks for watching. If there's a topic you'd like me to discuss in a future video, be sure to let me know down below. Thanks for watching. I will see you in the next video.